Good morning, everyone. Thank you for taking the time to join us this morning. My name is Shiraz Khan. I'm the head of the tax practice, Al Tamimi and Company across the Middle East and North Africa. I'm joined by my colleagues, Yanis Nanos, who's a transfer pricing advisor, and also Janet Gui, who's a senior associate in the team. Just by way of introduction, I'm sure a lot of you are already familiar with us. We're the largest law firm in the Middle East and North Africa region, with offices in all GCC countries and also North Africa. And we also have the largest tax practice at any law firm in the MENA region. I head up the tax practice across the region, and we cover all areas of tax, including transfer pricing. Now, the topic for today is transfer pricing. Of course, transfer pricing is a growing area in the region. Across the entire region, in all the tax laws, transfer pricing was already incorporated in there. A lot of the tax laws already have the arm's length principle embedded into the law. But in recent years, we've seen many countries introduce more detailed rules. For example, Egypt, followed by Qatar, then Saudi, and now, of course, UAE's introduced corporate tax, and they also have transfer pricing rules embedded into the law. I think the important thing about transfer pricing is that it relates to transactions between related parties. Why is it important? Because these transactions can be manipulated from a tax perspective and to achieve tax advantages. So, for example, you could inflate your expenses or you could reduce the price of your sales. And you can do this when you enter into transactions with related parties and as a result, pay less tax. And that's why the tax laws have anti-avoidance rules, which are called transfer pricing rules, to prevent you from manipulating the price in this way. So we've seen over the past few years the approach of the tax authority in terms of dealing with transfer pricing audits and some of the issues which have been coming up. We've represented clients in audits and also in litigation in different jurisdictions. So the purpose of today's session was really to talk you through the transfer pricing audit process in the Middle East, mainly Egypt, Saudi, UAE, and Qatar, and also talk you through the approach and the practice of the tax authorities in the region. We're also going to share with you some of the case studies and lessons that we've learned before we summarize some of the key takeaways. And at the end, you'll get the opportunity to answer or ask any questions, and we'll be happy to take them. So just to touch on a few has points before I hand over to Yanis. The session is being recorded, and we'll share a copy of the session after the session. Oh, sorry, a copy of the recording after the session. The audience is muted, so please do submit any questions via the Q&A function. As I said, we'll answer the questions at the end if we can, and of course, you're free to email any questions that we're unable to answer. There will be some polling questions as well, so be ready. And if you can't hear us, please make sure you're connected to your audio by choosing either connect through your computer, audio, or phone. So just to start off with a polling question, how prepared are you to manage a transfer pricing request from the tax authority? And the responses are well prepared, somewhat prepared, or not prepared at all. I'll just give you around 30 seconds to have a think about that and answer the question. Could we have the results, please? So it's an interesting outcome. I think not many of you are well prepared. It seems that most of you are somewhat prepared, so you have some knowledge of the rules, but perhaps you don't know what to do in order to prepare. And quite a few of you, 32%, are not prepared at all. So I think hopefully the session today will be useful in helping you understand what's required, what's happening in the region, what approach the tax authorities are taking, and therefore what you need to do. Because going forward, transfer pricing will become more and more important as the authorities become sophisticated. This is one area that can be challenged. And of course, you're required to make sure that all the transactions between related parties are taken place on arm's length terms. And in addition to that, you're able to support the fact that the pricing is arm's length. So without further ado, I'll hand over to Yanis Nanos, our transfer pricing advisor, who'll talk you through the rest of the session.
Thank you, Shiraz, for this. To start with, we're going to talk, as Shiraz said, on the transfer pricing audit process in the Middle East. Before we start with this, I think it's important also to give a brief overview of the transfer pricing documentation requirements across several jurisdictions in the region. So many of the countries, including Saudi Arabia and Egypt, had already introduced as part of their income tax law the arm's length principle. However, in 2018, Egypt introduced a formal transfer pricing documentation requirements, including the preparation of local file, master file, and country-by-country reporting. It was in one of the first countries in the region to have formally introduced requirements in line with the OECD. Following this, in February 2019, Saudi Arabia introduced the transfer pricing bylaws, where it was a requirement to prepare local file, master file, and as well as some local documentation requirements, including disclosure form and the affidavit. Within the same year, Qatar as well introduced formal transfer pricing documentation requirements, similar to Saudi, master file, local file, and as well transfer pricing declaration form. 2 years after, in Jordan as well, it's one more jurisdiction in the region that also introduced the formal transfer pricing documentation requirements. Jordanian requirements are very similar to Saudi, meaning that there is a requirement to prepare local file, master file, and as well affidavit and the disclosure form. In the UAE, last year, is almost a year now, it was an announcement of the introduction of corporate tax from 1st of June 2023. Following this, a transfer pricing regime has also been introduced in the UAE. Specifically, taxpayers with related party transactions, they have to comply with the arm's length principle, and at the same time, they have to file a disclosure form with their tax return. Further to this, they will also have to prepare a master file and a local file. This is it is mandatory to be prepared if you meet certain thresholds, and will be submitted upon request. With this, I will hand over now to Janet, that she will take us through the different requirements from an audit perspective in the different jurisdictions. We can't hear you, Janet.
There we go. So I was saying, thank you, Yanis, for giving us the overview of the latest TP development so far in this region. And in this session, what I will cover is basically to walk you through what the typical tax audit and litigation process is in the region, and with a focus on a few countries, as well as some of the key legal considerations that you should think about when you go through the audit or litigation process. Now, I think if you've seen, as Yanis has mentioned earlier, the tax and transfer pricing landscape has evolved radically in this region. In the UAE alone, we came from no federal tax regime to now having to deal with a new corporate tax regime, which also incorporates transfer pricing requirements in this regime. And you see that in Saudi alone as well, they've recently issued new tax regulations, tax procedure rules, and also rules governing the tax dispute process in Saudi. Now, the tax regulations are still under draft discussion. However, the regulations governing, how your tax disputes are being handled is already effective. So that's something, that you need to monitor as well. And in Qatar, the income tax law and regulations have also been amended in the past year. So in Egypt as well, there's the new tax procedures law. So, with all of this, the tax scene is constantly evolving. Well, we are never bored, of course, but it also adds an additional layer of challenge when it comes to tax disputes and audits in this region. And so basically a general overview of what a typical tax audit and litigation process looks like in the Middle East region is you would usually have, once a taxpayer files its tax returns, then the tax authority has a certain period of time, which we call the statute of limitations, to come back and audit this company. So typically an audit process would then involve the tax authority asking for certain documents and information to substantiate exactly the tax position or transfer pricing position that you've taken in your tax returns and filings. And then after the conclusion of an audit, the tax authority normally would then, if it's of the view that you have additional taxes to pay as a result of certain adjustments that they've made, certain transfer pricing adjustments to the positions or transactions that you've taken with the related parties, the tax authority would then issue an assessment. And usually then, if the taxpayer disagrees with this assessment, they have the right to then object to the tax authorities, to the tax committees, and in some jurisdictions, normally you would be able to appeal before the courts, or otherwise, with the exception of Saudi, for example, they have special tax committees to hear your case. So in the UAE itself, as some of you may already be aware, if you've gone through a VAT dispute or excise tax dispute, what normally happens is the FTA would issue you with an assessment. Now you have 40 business days from the time that you receive the assessment to submit a reconsideration request to the Federal Tax Authority saying, why do you disagree with the FTA's view in the assessment? Now, the tax authority then, can either accept or reject your request for reconsideration. And upon the rejection, you have a further right to file the objection before the Tax Disputes Resolution Committee within 40 business days, from the time the tax authority comes back to you with their decision. And if your disputed tax and penalties, of course, does not exceed 100,000 dirhams, then that decision from the Tax Disputes Committee is final. However, if it exceeds that amount, then you have a further right to appeal this before the courts. Now, in the initial stages, when the tax procedure rules were firstly introduced, this timeline was actually a lot shorter, and taxpayers only had 20 business days at every stage to actually appeal. But since the tax procedures law has been amended recently, they've extended this timeline now. So this is actually a good development, a positive development for all taxpayers in the UAE, because it actually does provide some time for you to assess your position and also take the appropriate measures to safeguard your legal position as well. Now, I would touch on this later, but essentially you also need to be aware in the UAE that you are required to settle the tax that's been disputed when you're objecting before the Tax Dispute Resolution Committee. And when you decide to appeal further to the court, you need to make sure that if there are any penalties, these needs to be settled. At least 50% of these penalties needs to be settled before you can appeal to the court. Now, ultimately at the court, then you have 3 stages. You have the Court of First Instance, the Court of Appeal, and the Supreme Court stages. So this is quite a protracted process before you actually receive the final decision from the Supreme Court. Now, it is also important to remember that, if you do not dispute a decision that you've been issued, if you disagree and you do not dispute it further, then that decision at that stage would be final. So it is important to make sure that, you appeal within the prescribed time limit as well to preserve your rights to dispute this position. Now moving on to Saudi. So Saudi is slightly unique in the sense that instead of going through the usual court process, Saudi has actually set up specialized tax committees, which are separate and distinct to the tax authority, to actually hear the taxpayer's case. And so, the process is quite similar to what you would expect in a normal audit process. The tax authority audits you, issues you an assessment. You have a right to object against the tax authority's assessment within 60 days. And the tax authority then has actually 90 days to come back to you to issue its decision against the objection. Now, it's important to note that if the tax authority does not respond within this 90-day time period, then it is a deemed rejection, and the timeline to appeal before the committees would start running from the end of these 90 days. Now, once you receive the tax authority's decision to this objection, you have two options. You could either submit your requests to the internal settlement committee within the tax authority, or you can go straight to the committees, the specialized tax committees, and appeal from there. Now, the only difference is that, of course, if you go to the internal settlement committee, then what the aim of that is basically to just resolve the dispute there and then with the tax authorities themselves. So when you go to a settlement, for example, you need to be prepared to actually, negotiate with the tax authority to come to a position to close this case. But it also depends on, the merits of the case. So it's always advisable to engage, your legal and tax advisors from the very start when you actually get this notice of the assessment, so that the merits of your position can be assessed. Now, if you decide not to go through the settlement committee route, you can still object or appeal directly to the first instance committee, and you need to do that within 30 days from the receipt of from the tax authority's decision to your objection. And essentially, if you disagree, you go through the hearings and everything, and if you still disagree with the first instance committee's decision, then you can appeal further to the appeal committee. Now, the appeal committee's decision is final and binding on both the taxpayer and Zakka. However, during this whole process, you could still, as long as you still have a case that's ongoing, at the tax committee's level, you can still suspend your case and also try to negotiate a settlement with the tax authorities at any time. Of course, it becomes harder in practice to reach a settlement when you reach the appeal committee stage. Now, moving on to the next country. Now, the tax audit and dispute process in Qatar is quite similar to the UAE. It has a court system. So essentially, when you receive the audit, the notice of audit, and then the tax authority issues you with an assessment, what happens then is that you have the right to object to the tax authority. The tax authority comes back to you with its decision to accept or reject the appeal. And then you have a further right to appeal before the tax appeal committees. And if you still disagree with the committee's decision, then you have the right to appeal to the Court of Appeal within 60 days. So it's important to note the distinction here between the Qatar and the UAE is that instead of having to go through the Court of First Instance, you can actually leapfrog and go direct to the Court of Appeal. So in reality, you really have two stages of courts to deal with before you receive the final decision. Next, please. Now, similarly to Qatar, the tax audit and litigation process is quite similar in the sense that you have your inspection, you audit, and then you get your assessment. Now you can object against that to the internal committee of the tax authority. If you still disagree with the decision at that stage, what happens then is that you can appeal to a separate and distinct committee called the Appeals Committee. And once the Appeal Committee comes back to you with a decision and you disagree with it, you can actually appeal against that decision to the court. Now, similar to Qatar, the court stages to hear tax cases is essentially in twofold. So you will have the lower administrative court, and you also have the higher administrative court level to hear your case. Now, once the higher administrative court actually issues a decision, that is final and binding, and it cannot be appealed further. Next slide, please. Yeah. So having, taken you through the typical audit and litigation process in the region, I think what's also important is to know some, very fundamental legal considerations when it comes to audits and disputes. Now, there is an emphasis on legal formalities in the Middle East region, particularly, and we have seen cases, where even though the taxpayer has a strong tax and transfer pricing case, for example, the case had, was thrown out just because they didn't meet the legal formalities. So that is the first step. In any case, it's important to firstly, satisfy the formal procedures before the courts or the committees can even look at the merits of the case. So if you don't even meet these basic conditions, then the committees and the courts would typically just strike out the case. And that means that you have no further recourse. Now, one of the things that you need to think about as well is when you get the notice of audit, you need to know what type of documents can be audited and requested from the tax authority. What is the time and place of audit if it's, if they're visiting your premises, and you need to also know your rights. So I think what happens normally is that quite often we see, companies engaging their legal representatives quite late in the process, and only, when they are actually about to appeal before the courts. And, when we're engaged at such a late stage, it then becomes even harder to defend your position based on what has been presented in the audit, because, sometimes the taxpayer may not be necessarily aware of their rights or what kind of documents that the tax authority can request. They could, request for information that it could be confidential or not actually within their ambit of the tax audit. And then the taxpayer inadvertently discloses this information, even though they have the right not to. So with that, I think, it is always good to make sure that you are aware of what documents can be audited and requested from the tax authority. Now, in terms of authorization, in order to actually have legal representation to dispute your tax or transfer pricing case, typically in most jurisdictions, you would require a power of attorney so that the company grants the rights to their legal representative to represent them before the tax committees or the courts. Now, there is a particular emphasis on this, and I'll say before the courts, and especially in Saudi as well, in the tax committees, just because they want to make sure that the right person, the right authorized signatory, has the powers to actually delegate this power of attorney to law firms or the legal representatives. And what happens normally is that we've seen in some cases where, there could be a manager of a company that has just signed up on a power of attorney. But when you actually look at the articles of association, or they didn't actually have that, that actual right to delegate the power of attorney. So it's quite important to make sure that the person who is issuing the power of attorney has the right, by way of the articles or by way of another power of attorney to give that right. Also in COVID, during COVID times, we had one situation where the authorized signatory was actually out of the country where he was normally based in, and because of COVID, he couldn't get back to the country. So what happened was that this resulted in quite complex situation, just because the power of attorney needed to be legalized in the country where he was based in, and then brought over to Saudi or UAE, where we were actually representing him. So this entire legalization actually took time. So it's always important to make sure that you have your authorized signatories readily available, you know where they are, And if they're not in the country, you have the appropriate controls to have the power of attorney issued. Now, when it comes to disputing tax cases, some countries like the UAE would require you to settle the disputed tax and penalties before you can even object to the tax committees or the courts. Now, it's quite important to make sure that you actually have the appropriate internal approvals for this, because sometimes the disputed tax amounts can be quite high. So it does take quite some time to line up the necessary internal approvals. And you need to always be aware that, of course, there's a time limit before you object. So it's important that you have those in place. Now, when it comes to deadlines for objecting and appealing as well, we've seen cases as well where, you know, taxpayers have considered, once they've objected to the tax authorities and they've never heard back from the tax authority, that's the end of the story. They've never heard back. So, you know, we don't know what the status is. However, in some tax legislations, there are provisions where there is a deemed rejection. So for example, Saudi, where the tax authority does not respond to your objection within 90 days from the submission of that objection, that is considered a deemed rejection. So it is always important to monitor that timeline so that you are aware that you have this certain amount of time to respond and preserve your rights before the tax appeal committees. Now, in certain cases, there could be tax authorities that also come back, you know, and issue you an assessment, let's say more than 5 years or more than 6 years after they've actually concluded the audit. We've seen cases where, you know, sometimes the taxpayers may not be aware that, you know, they actually have the right to just get the entire assessment struck out because the tax authority has not adhered to the statute of limitations. So, you know, the minute you receive the assessment, it's always important to make sure which period does that tax assessment relate to and what is the statute of limitations. And also, there are certain exceptions where the statute of limitations cannot be adhered to. So say, for example, in the UAE, the tax authority has the right to actually come back to you, assess you after this 5-year statute of limitations in cases where they have concluded the audit within the last year, within the 4th year of your filing of the tax return, or you know, in cases where you've not actually filed your tax return, or in cases of tax evasion where they actually have up to 15 years to actually issue you an assessment. When it comes to assessing the strengths and weaknesses of your case, it's also important to make sure that, you know, you have evaluated what are the merits of your position. Is it even possible for you to appeal further? Is there any right for you to do so? And this would affect how, you know, you play out your litigation strategy as well, because this would dictate whether you go for a settlement or whether it makes sense to defend your rights because it is a recurring tax or transfer pricing issue. So these are some of the things that you need to think about when it comes to litigating your case and defending your tax position. And with that, I'll hand over the session to Yannis.
Thank you, Janet, for this comprehensive analysis of the audit process across different jurisdictions. So in terms of transfer pricing environment in the Middle East, as we mentioned before, tax authorities have introduced transfer pricing documentation requirements a few years ago. That has resulted to a number of transfer pricing documentation to be in the hands of the tax authorities. Local files have been prepared since 2018, or in some cases for the years before in jurisdictions like Saudi or Egypt. Tax authorities, they have this documentation in their hands, and they have already initiated transfer pricing, a number of transfer pricing audit cases. So specifically, we see most of the authorities that they are focusing on transfer pricing to be, for the time being, Saudi Arabia and Egypt. It is expected that Jordan will follow up as well, and Qatar, and also UAE. From our experience as well from VAT, once a taxpayer start submitting local files and master files, then the number of transfer pricing audits in the UAE will also increase. A few things to pay attention in terms of the environment in the Middle East. One is that basically the number of transfer pricing audits has increased significantly. Another area is as well that tax authorities have been focusing a lot on hiring talent from the region, but as well they have been hiring people from overseas that they have expertise in transfer pricing. Another area to keep in mind is as well that transfer pricing has interaction with other taxes like customs, or let's say when you're buying goods from a related party. So tax authorities, they don't see transfer pricing in isolation. They see it together with other taxes. So this is something else that taxpayers need to keep in mind. Now, in terms of common areas of transfer pricing audits, of course, at the top of the list, we can always say that is transactions with low tax or no tax jurisdictions. That's a low-hanging fruit for the tax authorities, can easily raise questions around these transactions. What is the purpose, or is it really an economic benefit coming or provided to these jurisdictions? That's a very typical questions with regards to related party transactions with low or no tax jurisdictions. Another pattern is loss-making companies. It is very common for the tax authorities to question the losses of the companies. Most of the times they assume that it's coming because of transfer pricing. So it is in the hands of the taxpayers to prove that this is not related to transfer pricing. It can be for business reasons or startup or etc. any other reasons. So that's another area that is easily attacked. We have seen from the tax authorities. Another source of transfer pricing audits is as well royalty payments and in general expenses that can be deducted. Tax authorities can reject the deduction of expenses like royalty payments to a related party or management services received from a related party. As an example, in the case of a royalty payment, tax authorities may assume that there is no actual benefit received for the use of the know-how or the intellectual property from a related party. Another case is as well in terms of management services. In many cases, tax authorities question the deductibility of such expenses. They assume that these expenses, these costs are not really providing any benefit to the related party. That's a very common area, especially on the markup that is applied of such expenses. And we have seen that taxpayers, in many cases, they retain a certain type of approach or documentation approach on this. But because of the nature of the issue, it can be complicated. It can request additional information from the tax authorities. And as well, financial transactions. It's common again in cases of interest expense, a loan from a related party. Tax authorities can claim that this is not actually a financial transaction. They can recharacterize the transaction as an equity contribution, or they can, according to their own assessment, reduce the deductible interest expenses. With this, we can basically move to two case studies that we have included in our presentation for today. So we had a very recent case with one taxpayer that has been recurring losses for a number of years. At the beginning of the audit process, tax authorities collected the disclosure form. It was a Saudi taxpayer, collected the disclosure form and the affidavit, and as well, they requested for the local file and the master file. The client had explained in the local file the reasons for the business, for the losses. Tax authorities, however, when they assessed and they issued the assessment, they provided their own reasons that basically the taxpayer needs to make an adjustment. They rejected the losses. They did their own benchmarking analysis as well. And that's a very common thing that we have noticed, that in a number of cases, tax authorities are performing their own benchmarking analysis, and they disregard in totality or partially the benchmarking analysis prepared by the taxpayer. In our defense, we explain to the tax authorities that the losses are not because of transfer pricing, but of business reasons. And as you know, as a note for taxpayers to keep on when they experience losses, is basically to prepare a robust transfer pricing documentation, explain thoroughly in the transfer pricing documentation why they are in a loss position, and it's very important as well to have a very strong function analysis as well with this. Another case that we have seen with the tax authorities was with management services. So basically, a taxpayer, again, this is a case in Saudi, was receiving supports and management services from a related party. Tax authorities disallowed the management fees paid by the taxpayer in Saudi. The support for this is basically that taxpayers need to have intra-group agreements in place, explain what is the related party transaction about, explain what is the benefit received from the related parties, also have in place supporting documentation, including invoicing, cost allocation methodologies, explain how the costs have been allocated and why these fees have been paid by that specific party. Of course, have in place a local file and a master file to explain and give the overall picture of the business, and also to keep a clean record of all the related party invoicing. Now, a few things that we have seen and learned from our experience with interacting with the tax authorities. As I mentioned, this is coming mostly from Saudi Arabia and as well from Egypt. Firstly, we have noticed that tax authorities, in some cases, they don't seem to fully understand the taxpayer's business model. As an example, they can go through their local file and they can claim that this taxpayer is a full risk service provider and not a limited risk service provider as described in the local file. They don't really seem to have a full understanding of what is the business model and what is also the interaction of the taxpayer with the group. To put that in a context. So this is a very critical point, because based on the understanding of the business model, then you can have the corresponding economic argumentation on the taxable income of that entity in that specific jurisdiction. Another area that we have seen that is there is a lack of understanding in terms of the market or the industry outlook. So a client, as an example, was in a loss position. Tax authorities regarded this because of transfer pricing reasons. There were arguments that the whole industry was as well in a loss position. Tax authorities didn't seem to fully understand that it was not client specific, but it was mostly industry specific. So again, there needs to be an understanding that it's not only in certain cases the losses can be specific business losses, but also the microeconomic environment may be not in the favor of the taxpayer. And this is something that needs to come up in when someone needs to defend a taxpayer. Another area is we have seen that sometimes they totally disregard the benchmarking analysis of a client, or they cherry pick a number of comparables that is in their favor of their own analysis. And again, sometimes when even they do their own benchmarking study, we have noticed that they don't really disclose how they have prepared the benchmarking study. An integral part of any benchmarking study is the search strategy, how basically you end up to have a set of comparable companies. We have noticed that tax authorities, they don't, in many cases, they don't disclose this, and thus basically it's a weak point of when you're negotiating or when you try to resolve a dispute. And again, in another area is that there is a significant lack of economic argumentation when they basically provide the assessment why the taxpayer needs to pay an additional tax. Most of the arguments are from a formalistic perspective than from a pragmatic and real perspective. So in terms of that's the key areas that we have seen so far. So a number of key takeaways is that basically taxpayers, they need to have they need to perform a holistic analysis of their intercompany arrangements. They need to consider the pricing of these arrangements, the fundamentals, who is providing the service, as an example, who is receiving the services, any contractual arrangement that is around this, plus as well transfer pricing documentation. They need to have in place robust and contemporaneous TP documentation that reflects the economic reality. We have seen that at the core of most of the transfer pricing audits is the functional analysis. Sometimes tax authorities, they either seem to have limited understanding of the functional analysis, or because the functional analysis is prepared in a way that is not sufficient to support the pricing of the arrangement, tax authorities have argued to basically incur a transfer pricing adjustment. So it is critical for taxpayers to maintain a very strong and robust transfer pricing documentation, because this is their first line of defense. Another area of that taxpayers should be focusing is around the supporting documentation. As we mentioned earlier, they need to keep track of invoices, any transfer pricing policies that are prepared at the group level. They need also to substantiate the pricing of the related party transaction, and as well intercompany agreements. And a key area is, even if all of these are right in places, as well how to manage a transfer pricing audit and how to successfully win a case when you're facing with such a situation. So how we can help you with this? As we said, we can basically help you with preparing the transfer pricing documentation for you. This is your first line of defense. We can help you preparing the local file, the master file, and as well the benchmarking analysis. We have seen a number of cases, and we are in a good position to prepare such a documentation in a way that we basically avoid any future questions from the tax authorities. Even in the case of a field audit, that when you have basically received a request for an audit from the tax authorities, we can help you with basically the interaction that you will have with the tax authorities at that level. This can include functional analysis meetings and responses to these meetings. Another area is, once the tax authorities have issued their assessment, is basically to assist you with the objection, prepared objection in a way that supports your arguments and your case, and as well at the same time to assist you with in case of a settlement, if the taxpayer is willing up to settle with the tax authorities. And last but not least is we can assist with the litigation process, basically submitting any appeals at the higher courts or responses to the tax authorities at that level. And as was mentioned previously, as a law firm, we are in the position to represent you and defend your case against the tax authorities in any jurisdiction in the region. With this, I will hand over now to Janet. Janet, you are muted.
Thank you, Yannis.
Thanks. Thank you.
Yeah. And just to add on to what Yannis has said, I think, as the largest and biggest law firm in the Middle East region, we are the only law firm that has the biggest tax expertise across all the countries that we operate in. So we do have real on-the-ground presence, and we are familiar with the practices of the tax authorities. We have good relationships with the committees, as well as, we are familiar with all the court procedures. So really, when you come to us and we'll take care of all your tax and legal requirements. And because we are also a full service law firm, we have the expertise across all industry sectors, whether it's banking, telecommunications, automobile technology. We are covered in terms of industry expertise as well. So I think this is one of our value add when you come to us, and especially when you engage us from the outset to prepare your transfer pricing documentation as well. As Yannis has mentioned, this is when you do that, we are there for you, and we are able to defend your position from the outset. So this basically ensures a seamless assistance from end to end, from the time you prepare your TP documentation up right to the dispute stage. And with this, we'll just move on to the Q&A session and see if we've got a couple of questions here. Right, so the first question is basically, would the new Saudi tax procedures law impact the process of transfer pricing audits? So we do not expect significant changes to the way transfer pricing audits are being conducted. The new Saudi tax procedures law, which has been effective a few days ago, and basically the committee rules governing the dispute process has been effective a few weeks ago. And that has basically streamlined the process to bring in customs as part of the ambit of tax and transfer pricing disputes as well. And also with the new tax procedures law at the tax authority stage governing all tax procedures, we do not expect significant changes as well. Now, the second question, which Middle East countries will experience an increase in tax and transfer pricing audits in the near future? Yannis, would you like to answer this?
Yeah, thank you, Janet, for this. As we mentioned before, transfer pricing documentation requirements have already been introduced in a number of jurisdictions. We already see an increased activity from ZATCA in terms of transfer pricing audits. The audits can be initiated for corporate tax purposes, but transfer pricing is there. There are some questions around transfer pricing, let's say the deductibility of indirect expenses from a related party, or cases where we have a receipt of management services from a related party, again, or entity that have been in a loss position. So we have seen that this, and they're basically, a great number of I will say, transfer pricing audits coming from Saudi. Egypt is not really behind; it's also strong in that case. However, we haven't seen so much movement from Qatar and Jordan so far. I think it's because these countries have relatively recently introduced transfer pricing documentation requirements. With time and as tax authorities, they get more sophisticated in terms of transfer pricing, then they will also, with the amount of information they have received, they will also be able to initiate a number of audits as well.
Okay, thank you, Yannis. And the next question is, how do tax authorities focus on transfer pricing documentation?
Excuse me, sorry, Janet, I didn't hear that.
Yeah, how do tax authorities focus on transfer pricing documentation?
Okay. That's a very good question. So, look, from a practical perspective, taxpayers, in each jurisdiction, they have to comply with the corresponding transfer pricing requirements. Okay, so if you have related party transactions, as an example, in Saudi, you will have to prepare, subject to certain thresholds, of course, your disclosure form, affidavit, local file, and master file. So the initial point for the tax authorities to initiate transfer pricing audit is these documents. Once they have these reports in their hands, then they can initiate basically a transfer pricing audit. So I will say the local file, together also with the disclosure form, are the critical, plus as well in some cases the country by country reporting are the critical documents to initiate a transfer pricing audit. And of course, once these documents have been, collected, then the audit has started. Then we have seen many cases. As an example, they're asking for the cost allocation policy at the group level. They are asking for relevant invoices or proof that benefits have been received from a related party, etc. So there is a lot of supporting documentation or intra-group agreements as well. There is a lot of documentation that comes apart from the local file and the master file.
Thank you. So the next question is, which databases do tax authorities use in the Middle East region?
Yeah, I think this is a very important question. We have seen that tax authorities are basically using a database that also most of the large multinationals and taxpayers are using. As an example, the Bureau Van Dijk database is the audit-based database is something that is widely used by the tax authorities. So again, taxpayers, they need to keep in mind that whenever they prepare a benchmarking study, they need to use data that are publicly available and that can be easily verified. But I can say that the practice in terms of benchmarking analysis is really in line with what we've seen in other more developed from a tax perspective jurisdictions.
Okay. The next question is it expected that transfer pricing audits would take place in the UAE? Is transfer pricing in the UAE linked to corporate tax?
Yeah, I think as we discussed previously, is that from 1st of June 2023, there is a corporate tax regime in the UAE. An integral part of this is the transfer pricing rules as well. So companies that are located in the UAE, together with their tax return, they will have to file the disclosure form. Still, it's not clear what will be the content of the disclosure form, but most likely we're expecting something similar with the likes of Saudi Arabia or Qatar. Having said this, they have basically to prepare the disclosure form. That's one, and second, they will also have up to certain thresholds and requirements. They will also have to prepare and submit a local file and a master file. Taxpayers in the UAE, even if taxpayers, even they qualify as they are qualified free zone person, they always need to keep in mind that they have to price their related party transactions on an arm's length basis. So that's a very critical component of this. And how do you prove that you are on an arm's length basis? Is basically you need at a minimum to have a benchmarking analysis support to prove that you are you are conducting transactions on an arm's length basis. So having said this, it is, I think, once tax authorities start collecting, data around transfer pricing and collecting this information, they will start asking questions. So if you are a qualified free zone person and you are assuming, based on other requirements, is that you are conducting your related party transactions on an arm's length basis, then you will have to be able to prove that you are satisfying that requirement. And I guess, Janet, also from your experience with the FTA and with VAT audits, I think I think tax authorities will be rather than aggressive towards the transfer pricing. That's at least my feeling from what I have seen from other type of audits in the UAE.
Yeah, so in the UAE, I think based on the VAT and excise tax experience, I guess once the UAE introduces a new tax regime, typically what happens is that the authorities are focused on ensuring that taxpayers are educated and aware of this tax, and also with compliance with the tax regime. Now, once they start collecting this information, once more taxpayers actually file the tax returns, as Yanis has mentioned, they would then have this information database that they could use, and they also have, again, remember that they have an overview of how all businesses file the tax returns. So it would be a matter of time before transfer pricing audits would also take place in the UAE. Now, of course, as I've mentioned earlier as well, it is also important to always make sure that the tax authorities have actually followed the statute of limitations under the tax procedures law in the UAE, or any country for that matter, because essentially what the statute of limitations is that it tells you that the tax authority has a certain amount of time before they can come back to you and issue you an assessment from the end of the tax period. And once that tax period, once that period has expired, they actually don't have that right to issue you with an assessment. And if that happens, then you could go to the courts or the committee to actually say, hey, look, the tax authority has not followed the procedures. You should strike out this assessment. All right, I think we are conscious of time. We have capacity for one more question. You've mentioned that it's not possible to object before settling. So what happens to the amounts paid for the settlements if the objection was successful? Are these amounts refunded? Short answer is yes. So we had a successful case in the UAE, recently for VAT, and essentially, all taxpayers are required to pay the VAT or penalties that are disputed before they could object before the committees. And essentially, once the entire case or final decision has been issued, you can then go to the tax authority and ask for a refund. Of course, there are certain procedures that needs to be followed as well, where we say that we want to enforce a court decision, and then essentially the court will issue an order asking the tax authority to issue you with a refund. So all the procedures would vary from country to country, but that's essentially, just to give you an idea of what happens. Right, I think time is up. So thank you very much to all participants today. We hope you found this session useful to you. And if you have any questions, or if you've not had your questions answered, you can feel free to reach out to us.
Thank you all for your time today.
Thank you, everyone.
Thank you.